Hi, and welcome to Macro Wednesday, where we talk macro and try to make sense of markets that they don't really make much sense unless, of course, bond prices are up, and then they make perfect sense. I'm Steven Van Metre. I'm your host. Thanks for joining me today, and I've got a great episode for you today. Now, we took a little break on Monday because I was invited back to Martin North's Walk the World, and if you haven't seen that episode, it's linked in the description below. Go check it out. It was a great 30-minute interview, and I really enjoyed being on Martin's show, and he said we can come back anytime. So we're certainly looking forward to that. And also want to thank all of you who commented, reached out to me directly about, kind of where we left at the end of Friday with potentially, what's coming, with the show potentially ending. And so many of you just reached out and said, hey, we love your show. We love you, and don't quit. We need you. We want you. And that really means a lot to me. But there's going to be some changes going forward. And I just want to say the outpouring of support was just incredible. I mean, I had people that came and said, hey, can I help you do this? People that audited the channel and said, here are some suggestions to help you. Several of you even went out and approached some of your favorite content producers. In fact, I got an email from Tom from Palisade Radio. I'm sure many of you know who he is and his show, and I'm going to be interviewed next week. So big thank you to whomever helped set that up. I appreciate that very much. I even had one person write a business plan for me and was willing to help and try to figure out what can we do. Some of you have suggested we do offer trading advice in some sort of fee platform. I mean, there's just so much great advice. And some people even reached out and said, hey, I'd like to do business with you. Tell me about your services. And I want to thank all of them too. So here's what we're going to do going forward. And my time's been crunched a little bit. We put a lot of time and effort in the show, and a lot of the feedback I got was, Steve, shorten the episodes. Great. We're going to do that. So we're going to shorten the episodes. We're going to largely cut out the Q&A. I know it was real popular there for a brief while. The way we're going to handle questions going forward is if I get a lot of questions on a specific topic, then I'll do an episode about, around that question where we answer it. I'm going to cut back on the time we go through the macro data. And I'm going to focus on the macro thesis that I built together because it's all playing out. And I want to have more time to look at various charts and to really dig into thesis because I want you to comment. I'm really enjoying everything all of you are saying in the comments and the feedback I'm getting. And of course, some of you said, hey, you got to tell us to like your video. So my wife made a thumbs up. And some of you said, hey, we need to know to subscribe. Well, we got one of those too. And I'm running out of space on my desk for things to put up in the air for you. So with that, I want to get into, because I'm so excited as the thesis is really playing out. In today's episode, more proof the banks are going to crash the market. Now, we did a show on this before, and it got quite a bit of attention, and it wasn't because I was looking for attention, it's because it's actually how this whole system works. Macro, when you look at, what is macro? If you came to me and said, Steve, I want to study macro, I want to learn macro, where do I start? Study monetary policy, study the history of central banking, understand how and why the Fed does what it does. Because macro begins and ends with the Fed. Now, it isn't just as simple as, if the Fed is easing, buy stocks, and the Fed is tightening, sell stocks or whatever. No, there's cycles to it. There's periods where when the Fed is easing by buying bonds, you might want to be buying bonds. And there's periods when the Fed's buying bonds you may not want to. So there's cycles to this. But there's one really critical player in the cycle that really doesn't get a lot of attention for their role, and that is the large commercial banks. And the reason, on Fridays we talk about, the credit data is not just because the credit data is critical in a debt-based economy, because if you want a debt-based economy to expand, you have to expand the amount of debt. Now, hopefully, your debt expansion is going into businesses or consumption that's causing more growth. It doesn't always do that. But that's the first goal, is you need to have an expansion of debt. So the banking data by itself helps us gauge, are we seeing debt grow or contract or stagnate? Where is that at? But the banks themselves are major, major players, because the banks, they really control the Fed. And you say, well, what? Yeah, I mean, I know we think of the Fed as this independent body, and by all means they are. But they're a reactionary body, and they certainly can be manipulated by the banks. And that's why when we look at what's going on with the banks right now, and then you confirm this with the macro data, the charts, and everything we're going to look at in today's episode, you can see that this whole thesis that bond prices are about to take off, yields are about to go down, it's about to drag stocks down, it's about to drag risk assets, as I believe gold down, and it's going to drive the dollar up. I think we're potentially within a couple weeks of seeing this start to play out, and perhaps in less than, and if not, we're within a 60-day window. It's right here, right now, and the banks are key. So what is going on with the banks? Well, you have to understand, what is the large commercial bank's relation to the Fed? Well, yes, they're shareholders. If you go back and look at the creation of the Fed, you do know that the large commercial banks are shareholders, but that's not entirely the piece that we're looking at. Think of the Fed as the father, the parent of the Federal Reserve banking system. Now, just so you know, not all banks are members of the Federal Reserve banking system. Credit unions generally aren't, and there are community banks that aren't, but the large commercial banks are, and those are the ones we really are interested in. Think of them as the children. And the children generally want to do what dad tells them to do. And even though banking post-Great Financial Crisis hasn't been that great of a business, because they have just been regulated left and right, to the point where banking, in terms of how they've made their money in the past, just isn't the same, and they're not as strong as they used to be, and they're not as big as they used to be, even though from a consumer standpoint it just seems that these large banks are just outrageously large. They're just not what they used to be. But the bank said, okay, Fed, you need us to buy bonds because you and all the other banking regulators around the world decide to penalize us for the Great Financial Crisis and put the blame on us. Fine. And they've been buying bonds for a long time. Now, we know that the banks are the smart money. We can go back and look at the charts. They've been buying bonds back since October 18. Now, no, I didn't flash the chart up for you to see. I've just made a mental note that I had the right month and date. So, and they've been buying prior to that too. So that was really the peak. They've been buying bonds back, 2016, right after the election, when everyone was selling bonds. The banks really stepped up to the plate and bought them. And, everything was okay. The executives recently were happy. Banking business wasn't overly great, but they were able to buy their stock back. And that was okay, because then the board could grant the executives more stock options, and the executives could sell those options into the flow of share buybacks. And, hey, even though business may be not that great, I can still buy my shares back and sell my shares into the buyback flow, and I can get rich. And, hey, I guess that's pretty good at the end of the day. So what happened recently with the banks? Do you remember? Do you remember the stress test? Now, the stress tests I really think are a joke, because they're open book tests. Even worse, the banks are given the test ahead of time. Like, here's a test, here's all the rules, and they didn't do very well. I mean, or at least not well enough. And what did the Fed do? Shame on you banks. No more share buybacks for a quarter. And then I don't know what else I don't remember the other thing. I think they maybe limited somehow executive compensation or something else, but the share buyback was a big deal, and the Fed said, stop it. And this is like sending your kid to the room without dinner and saying, look, bad kid. And except these aren't kids that learn from their lesson. These are kids that say, look, you know what, Daddy Fed, we're going to get even. We don't like this. We don't like being treated like this, and we don't want to be embarrassed. It's you who is going to be made a fool of. And they're looking at Fed Chair Powell and said, we're going to make you look like a chump, and you wait and see. So what happened since? Well, we just got the answer in the Senior Loan Officer Survey, something that most professionals don't even look at, and most people that look at macro they don't understand what it means. And this is a core part of my thesis in my replay of the GFC, is that banks would tighten financial standards. And guess what they did? Conveniently, right after the Fed punished them. So the bank said, fine, you're gonna punish us. We're just gonna tighten financial standards. Now you go, well, what's the big deal? Someone in the banking industry right now might say, well, that's great because they're pretty tight. That means they can only go down. Yeah, keep thinking that. Keep thinking that's what's going to happen because it's not going to play out that way. Why would banks constrict credit and tighten financial standards? Because that's what it is, right? I mean, people always want to borrow money. I mean, if banks were pretty much doing it like they were before the financial crisis where, fog and mirror, you can get a home loan, people would be down borrowing money like crazy. But in a debt-based economy, remember, that's that expansion of credit. So if you get a stagnation of credit growth, which we have been, or a contraction of credit growth, which we are in some areas, what do you end up doing? You end up deflating the economy. You crash the economy. And what does that force the Fed to do? A lot of monetary easing. And the banks know that. So what did they do? They just tightened financial standards. Boom. What is that going to start doing? Constricting credit. And what does that lead to? Well, it does lead to lower interest rates. Why do you say does it lead to lower interest rates? Simple. Because banks right now would love to lend to some people, but they only want to lend to people that they already know don't want to borrow. Hey, you're out of debt, got a lot of assets and cash flow. You don't want to borrow, do you? Nope. Okay, well, they want those people to come in and borrow, and they're not interested. And we are going to start seeing in the months to come a lot of these loans come off forbearance, which, of course, the banks would like to see payments coming in, right? You'd like to see some cash flow if you're a bank. Are these people going to be able to make their payments? Doesn't look like it so far. So what do the banks ultimately need? Lower interest rates. What's the Fed not giving them? Lower interest rates. So what are they doing? They're throwing a tantrum. Let me show you the Senior Loan Officer Survey. This is really cool stuff. So this just came out this week. And here we go. Regarding loans to businesses. And yes, some of you asked for me to make these bigger, so hopefully these can help. Respondents to the July survey indicated on balance they tighten their standards and terms on commercial and industrial loans to firms of all sizes. Banks shockingly reported weaker demand for commercial industrial loans from firms of all sizes. So check that out, right? Hey, we're going to make it harder for you to get a loan. And for some reason, people don't want to get a loan. Wow. All right, let's go back to that. There we go. Meanwhile, banks tighten standards. Here we go. Tighten standards and reported weaker demand across all three major commercial real estate loan categories. Look, that's a no-brainer. Commercial real estate, obviously, right now is in trouble. So tighter standards and less demand for construction, land development loans, and non-farm residential loans and multifamily loans. No shock on that one. How about we go on for loans to households? Banks tighten standards. Now, do you think households are going to want to borrow some money to get through this crisis? You bet they are. Across all categories of residential real estate loans. Remember that hot real estate market? It's going to turn down. We already know on a rolling 90-day basis it's showing no growth. Guess where it's headed next? Contraction. And across all three consumer loan categories, credit card, auto loans, and other consumer loans. How about that? Banks reported stronger demand for all categories of residential real estate loans. So people are wanting loans and they're saying no. And weaker demand for all categories of consumer loans. So right now, consumers can some consumers can get home loans, but everyone else, no. Everything else is getting worse. And let's see, they were asked a special set of questions. And let's see, here we go. Banks, on balance, reported that their lending standards across all loan categories are currently at the tighter end of the range between 2005 and present. So let's look at this in a graphical form. And again, I've made all these slides bigger, so hopefully this will help those of you who said we needed to do that. And this is fantastic. If you could only, in your mind, overlay 30-year Treasury Yields or 10-year Treasury Yields from these charts. Now, they do have some of this data on the Fred database, but it isn't this whole picture. So unfortunately, I could show it to you, but it doesn't have the same effect as seeing these big picture charts. Check this out. Now, what happened in 2000 to 2002? There was recession. Look at how tight loan standards were back then. And then in 2008, look at what happened. Hey, loan standards tightened in late 2008. Oh, there was a big market crash. And look now, you have the second tightest lending standards in commercial industrial loans in history. And people say that we're on the cusp of the next great bull market run. Really? According to this chart, no, not happening at all. So again, the first chart, net percent of tightening lender standards for commercial industrial loans. How about net percent of domestic response increasing spreads of loan rates over bank cost of funds? Well, look how tight it was during the dot-com bubble. Look how tight it was during the GFC. Look how tight it is now. This is not synonymous with a bull market. This is synonymous with a bear market. Net percent of domestic response reporting stronger demand for commercial industrial loans. Well, shocking. You make it more difficult for people to borrow money and less people want to borrow. That's fantastic. Gee, Fed, I'm sorry that people just don't really want to borrow right now and it's leading to credit contraction. I don't know why that's happening, but you can see this happens every time. Look, it happened going into the dot-com bubble, happened going into the great financial crisis, and it's happening again. There's only 4 slides here, but they're so interesting. How about net percent of domestic response tightening standards for commercial real estate loans? This is a no-brainer. Who really wants to go out and borrow money for commercial real estate right now? Wow. I mean, talk about if someone said, what's the riskiest thing you could invest in right now? I think commercial real estate would have to be toward the top of my list. I mean, how many people are going to be working at home for a while? I mean, there's a lot of businesses that are finding out. And as someone who's self-employed, anyone here who is self-employed or has been an executive for a small business, you work more hours when you're working from home. And it's shocking. Businesses are finding out that people are putting in more hours from home and are more productive. Do you think they're going to want to change that anytime soon? Virus aside, they're getting more productivity for the same wage? Yeah. Sign that trend's going to continue. So look at this. Tightening standards for commercial real estate loans, second highest level in history, just shy of the GFC, and you can see how tight it was going into the dot-com bubble. How about net percent of domestic response reporting stronger demand for commercial real estate loans? As you would expect, that most people right now are really not interested in borrowing. I mean, they probably are, but they realize they can't. And you can see that this is right on par with typical levels that respond to recessions. How about net percentage of domestic response tightening standards for residential mortgage loans? Now this chart is split, but you have to look at its continuous chart because the data has changed. But you can see going back going into the GFC, wow, that really tightened up. Anyone who lived through that knows how bad the real estate market was. And what is everyone telling me today? Oh, no, Steve, real estate's not going down. Real estate's forever going up. It's a safe place to put your money. It's super liquid. Look, you want to know the definition of liquidity is it ease to sell. You know when the easiest time to sell is? At the top. Think about it. So what do you see right here? Tightening standards. Wow, the second highest level since the GFC. And this is of last quarter. Do you think it's getting better or worse? Remember, everyone's like, oh, well, this is a look back. So no, it is a look back. Do you think it's getting better? No. What do you think is going to happen to all these people that have jobs in the mortgage industry and at banks? Do you think they're going to be keeping their job as conditions tighten and the number of loans drop? No, they're going to miss their quotas and all this stuff's going to change and they're going to be out of work. It's all going to be a replay of what happened before, and there's a reason why. It's because the large commercial banks what do they want? They want lower interest rates. They want to lend so they make money. They want to buy their stock back. They want to compensate their executives for doing nothing and give them big stock options and let them sell their stocks into the buyback flow. They're not happy. And so they're going to force the hand of the Fed. This is one of those 3 pillars that I look at. And when you say, man, Steve, I don't know if your thesis is going to play out. You look at these charts. You look at what the banks are doing, and then you look at where Treasury Yields are at, which we will, and you look at speculative positioning, and you look at the dollar, and you go like, holy smokes, this is about to go soon. Yeah, soon. How about net percent of domestic response reporting stronger demand for residential real estate loan? Well, of course, people always want to buy bigger homes and more expensive homes when interest rates are low. Guess what? You should always buy when interest rates are high and prices are low. One of my clients, he likes to buy rental real estate, and he's a really smart guy. And he's like, look, you can't make money buying rental real estate at the top. You got to buy it while it's low. You got to just stack up your cash and wait and wait and wait and wait and wait. And then when it's cheap, you just mop it up because you got to pay it off. And he says, if you want to be successful in the rental market, pay your loan off in 5 years. Not many people can do that. But there's always this demand because interest rates go down. What is that usually a signal initially? A peak. So here we see in this chart, look at going into the bubble, the dot-com bubble, demand for real estate was strong and then it collapsed. Where's 2000? Yeah, the collapse going right before the demand had started to drop off going into the dot-com bubble, not dot-com bubble, the GFC, and it was way down. But look here, people are just giddy about real estate because they think real estate prices aren't going down. Look, real estate prices go down when you constrict credit and you keep people from buying. Just how it works. How about net percent of domestic response tightening lending standard for consumer loans? Off the charts. Look at that. Higher than it was during the GFC. People can't get credit. What does that mean? And if they can't pay their bills, default city. Net percent of domestic response reporting increased willingness to make consumer installment loans. Yeah, no. You want a loan? Forget that. Look at that. Second worst time since the GFC. How about net percent of domestic response reporting stronger demand for consumer loans? Look, consumers already know they can't get money. And those that have tried realize, that door is closed. If you can't borrow money in a debt-based economy and you can't see credit expand, you get a deflationary crash. And right now, nobody thinks that's coming. Well, okay, a few of us do. I mean, it is what it is. The smart money knows this is coming. Who is the smartest of the smart money? The large commercial banks, because they manipulate the rules. Look, Fed, you want to take our candy away? Fine. You want to send us to a room? Not going to happen. We're going to make you look like a chump, pal, and we know what you're going to do because he's already shown his cards. Powell's a terrible poker player. If you could play poker against a guy, you could clean him out. Because he already played his hand in March. He said, look, I will stop at no end. There's no limit to QE. And what does QE do to interest rates? Boom, takes them down. What do you think all these people cashing out their stock want to do? They want to buy it back at a cheaper level. Let's look at the next phase of this thesis. How is the bond market look? Treasury yields tell you everything. So here's the 30-year. And we'll look at TLT because it just gives us a little more granular picture. This is a topping pattern inside this massive topping pattern going back to 2012. If you can't see this, it's very obvious. This is what a topping pattern in technical analysis looks like. And it says that as you break through the topping pattern, people that were sellers here, because they were sellers, this is how yields go up, they become buyers. And they did. And now we're in another topping pattern inside of that kind of major structure. And you can see sellers right here between this 1.2 and 1.25% yield on the 30-year. And when this breaks down, this thing's headed low, 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 low. I think it goes to zero. And all the banks have to do is keep tightening lending standards. If you don't think they're going to do that, they will. Let's look at TLT because it's really telling us kind of the big picture story. If you think this is a charting pattern that tells you the bond prices are going lower, you need to get out your technical analysis books because it's the complete opposite. This is clearly a bottoming pattern that says prices are going to go higher. If I took TLT off of this view and said, what does this chart look like? People say, oh, wow, it's a bottoming pattern. And if you come back to kind of where this started, back, say, in mid-April, you've got roughly about a 2.5 months. So technical analysis likes symmetrical patterns. So you got a roughly a 2.5 month pattern between right in here and here. So you have late April, late May. Actually, I meant to go, late May. Did I say 2.5 months? I'm off a little bit. Somewhere earlier, I had this figured out. But, when you do live and you don't edit, It does actually kind of make you look dumb sometimes. Anyways, we're pretty much toward the other end of this symmetrical pattern. Maybe I was looking at it from back here, telling us we're potentially within like less than 2 weeks of this thing breaking out. And if we zoom into TLT, what do we see here? We've seen this consolidation pattern between these two dotted purple lines, where in the center point is in this solid purple line. In technical analysis, it likes symmetrical patterns. So you see it's oscillating between here. And there's actually another line in here, and this is a range. So it's trading in this consolidation line, bing, 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 bing. And then it bounced out, and I thought, all right, maybe this is it. And it entered a new consolidation pattern. Why is it doing this? Because the smart money, the big players, haven't gotten every last little bit of bonds they can get out of the market, and they want it. And so I'm thinking, okay, maybe it breaks out, maybe it breaks out. Nope. The sellers jam it down into this lower consolidation zone. Then it pops back out of it. Now, where is this top zone? It's this dotted cayenne line. Dotted cayenne line is the middle one too. Right here, I'll change it so it's solid. So we have the dotted line on the top, and then the solid purple line. In your mind, put a dotted cayenne line right down here. So you have a consolidation zone and another one right on top of it. So what happened in overnight trading is they jammed it down into that lower consolidation zone. Sellers were able to do that. It bounced off the midpoint. And if we zoom in today's trading, you can see it oscillated right in between where these kind of two rivers, this confluence is swirling around. And then they finally got it kind of down to late trading. They shoved it down, and then it popped back up, and right at close, they jammed it down. Believe me, this is very close to breaking out. So we're looking at a consolidation zone and then one right above it. And what's above this top line? Nothing. Blue sky. So you can see, not only does the macro data tell us, hey, something really cool is going to happen. We have the senior loan officer survey tell us, yeah, the banks are not happy and they're going to keep tightening lending standards until they get what they want. The chart of the bond market saying, yep, that looks really clear that something interesting is going to happen. Where do we go from here? How about speculative positioning? So let's jump over to hedgeopia.com. Now on 10-year, we see that hedge funds are slightly long. Okay, they've got to be a lot longer than this before a bottom in yields is in. Look at the 30-year. They dropped their short positions down almost. I mean, we're very close to the shortest position they've ever been in history. So why does this matter? Because who do hedge funds usually get their treasury future shorts from? Securities dealers. Who are they owned by? Large commercial banks. Who CEOs and other people get out and say, man, it's a great time to short the bond market. They did this before. I mean, there's this point where I think it was Jamie Dimon. Someone pulled all the times he had said short the bond market. Meanwhile, his bank was buying bonds, and then when they peaked, and they made a killing on all these people that were short the market. So you're like, well, who's going to buy all these bonds? Well, for one reason is there's going to be speculators that are going to buy it. And they're telling you they're super short yields. They're pretty much all in. They got all their chips on the table as of last Tuesday. Very interesting. Oh, yeah, we're going to get to that chart in a moment. So we see speculative positioning is really deep here in the 30-year. And we know that 30 years don't bottom until specs are long. So they've got a long way up and a lot of bonds to buy to reverse that. That's fantastic. Then this is a chart I do not have access to, but it was conveniently posted today on Zero Hedge, thanks to Jeffrey Gunlock. One of the, shall we just say 3 pointed bond kings? Because do I get added to that list? I think that's only fair, right? I mean, come on, who's the bond king, right? Put it in the comments. You know it's me. All right, let's look at the MOVE index. The MOVE index, because I don't have a Bloomberg terminal and I don't have access to it, I can't show it to you other than when someone else posts it. It is the VIX of the bond market. It's a Treasury VIX, as it says here. Now, unlike the volatility index for the market, when volatility rises, what happens to stock prices, right? You already know they go down. In the bond market, it's the exact opposite. So look at volatility here in mid-2007 on the bond market. It started to rise and bond prices went up. Look at here in March, bond volatility rose And it went up. Now, where's the move index? The lowest point since 2003, 2002. Lowest point. Let me reiterate, the lowest point. So if you were looking for some sort of validation, that interest rates were going down, what would you want to see? Would you want to see the move index high or low? Well, you'd want to see it really low, because if it's really low and the chart of the bond prices or treasury yields are signaling a major move, and speculative position is super deep, and banks are tightening lender standards, and all the macro data says that yes, this is going to be a big explosion higher in bond prices and the move index, this is exactly what you want to see. Now, if the move was way up here like it was in 2008, we wouldn't be talking about that right now. But you're looking at this telling you the risk in the bond market is super low and only likely to go higher. And when it goes higher again, it brings yields up. Now, I said that I was going to keep these videos short, but I got to look at two more things real quick. And because we had Monday off, we'll go just a little bit longer. It's the dollar. The dollar is a critical piece in this because when you understand the trifecta of tightening, right? What do you have? Banks tightening lender standards. Now, who's going to tell them to loosen them? You think the Fed's can come in and like, hey, here's Chair Powell on the phone, and I think your lender standards are a little too tight over their big banks, and I want you to ease them. And then what are they going to do? Sorry, Fed Chair Powell, we don't listen to you. Why not? What they're going to demand from him? Give me some QE, and we want you to go in and loosen all the regulations and whatnot, and then we'll think about lending. So the banks, boom, big piece of the tightening of what's going on with lending standards. Number two, how do you further tighten financial conditions? So one is you keep people from borrowing. Number two, you drop interest rates, because we know in a debt-based economy, low interest rates lead to tight financial conditions. So you got to drive rates down and really just tighten this thing up so bad that no one will lend. And I know people in the banking industry say that can't happen. Oh, it's going to happen soon. What is the third way you tighten things, where you make literally the Fed squeal uncle, right? You got their arm twisted so far back, the Fed Chair Powell's like, okay, I give up, I'll do anything. You drive the dollar up, and everyone's mispositioned on the dollar. They think the dollar's going to zero, but look what happened. You've got, let's zoom into this 10-day chart, a double bottom on the dollar, and there you can see it potentially. I'm not saying this is it, but it is a good sign potentially for the dollar, a double bottom. And you say, well, it broke through your trend range there. Yeah, it did. But it's dropped below here before and found support. So I added this dotted purple line, and you can see it's found support right in here before. But a potential double bottom here, now that's pretty interesting, because if this is the bottom of the dollar, and you've got everyone that's massively short the dollar, look at speculative positioning on the dollar. Well, let's look at the euro, right? Because everyone's crazy bullish about the euro. You have nearly the longest nearly the largest long position in history of the euro, matched by, where's the dollar in the speculative positioning here? One of the shortest positions in the dollar. I don't know if it is, it's not the shortest, but it's very short. Everybody's betting against the dollar. You get the dollar to rise, guess what happens? You get three versions of tightening simultaneously. The Fed calls uncle. They slam the QE gas pedal all the way to the floor. Everyone that's bought bonds, i.e. the banks, now offload those into smart money, that is what it is. Offload those bonds at super low interest rates, really high values, make their money off the Fed, say thank you very much, and then they turn around and buy risk assets cheap, because that's how it played out in the GFC. So what do you think about today's episode? Let's join in, get some comments going. Be sure like the video, because my wife made this, and would make her very happy if you like the video because she made this. Be sure to subscribe. Tell your friends and family. We're going to be back Friday. Look at the credit data, because guess what? We can already predict what's happening in the credit data. It's going to contract. I'm Steve Van Metre. Thanks for watching. Thank you for your support of this channel. It means the world to me. And hopefully we'll be in bigger and better places in the weeks, months, and years to come, especially when you see this big thesis play out, because it's going to happen real soon. The content of this video is provided as educational information only. It's not intended to provide investor and other advice. It is not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.